Hi, today we're going to be talking about 5 things to know when investing in the stock market. Let's get into the video. Number 1 is going to be the market can be volatile, so do not panic sell. So volatile basically means it can go up and down in the short term or long term. Most of the time in the long term it's going to go up, and well, not most of the time, over 20 to 50 years it's always going to go up. But over 5 to 10 years, most of the time it's going to go up. So in the short term, like 6 months to a year, if it's going down, don't just panic sell. Be patient and wait. And unless anything really changes with the company and how they're growing is going to drop dramatically, like anything like that, then you can look into selling. But unless something like that happens, just hold on, and it's probably going to go back up over the long term. Now let's get into number 2. So for number 2, we're going to be talking about how important it is to reinvest all the dividends that are paid out to you. And I'm not talking about like forever to reinvest the dividends. Eventually your goal is to have your dividends pay for your expenses, all your monthly expenses and your yearly expenses. But I'm talking about when you're still on the journey to doing that and you're still trying to grow your passive income, reinvest all dividends that are paid out to you. That will help your portfolio grow a lot. Don't take those out and go buy something. Put it back into the company. Don't even think about those. Just set that off to the side and reinvest it. You can, for Charles Schwab, I know there's a reinvestment plan where it automates it, so you don't have to do anything. It just automates the reinvesting. And you can also set up a plan with some brokerages that it invests a certain amount like every week or every month. So I would look into doing that if you don't have like the time to take and invest it back into these companies. I would look to automate that. And yeah, let's get into number 3. Okay, number 3 is going to be consistent with your investments and try to put as much money as possible into your investments. This simply means that you don't need to invest a lot of money one point and then invest like a really small amount of money another point and then not invest for like a 6-month period. You just need to have like a schedule, like invest every month, invest every 2 months, like something like that to keep you on a schedule so that you invest more and you don't forget about it. And not just invest at random times. Like, if you can do that and you don't like forget or buy something because you didn't put that money aside, then you go ahead and do it. But for most people, it would be better to just have some plan where you can invest every month, every 2 months, every 3 months, every year. It doesn't matter. Just have some plan. And then try to save as much money to put in your investments, because every dollar in this day is going to be worth a lot more in 10 years, 20 years, 30 years, 40 years, as long as you invest it and don't just spend it on something that's going to depreciate in value and not appreciate in value. Now, let's get on to number 4. For number 4, I'm going to be talking about how it's important to not put all your money in one stock, but also don't put all your money in a lot of stocks, like 100 stocks. Now, it's fine to put all your money in one stock if you only have like $500 to $1,000. But beyond that, like 2,000, I would do 2 stocks. And then I would put like 1,000 in each stock until you get to 5,000. After 5,000, you can begin splitting it up, and like 2,000 in each stock when you get to 10,000, like something like that. But then for don't put money in 100 stocks. I mean, it's fine if you have the time to pick out 100 stocks and you don't just want to invest in an ETF. That's fine. But I think investing in an ETF with a low cost like a Vanguard, like a 0.06, that's like nothing to what you get in return off of that investment. So if you're going to invest in 100 stocks, you might as well just put all your money in an ETF. Now let's get on to number 5. Okay, for the last point, number 5, we're going to be talking about how you need to do a lot of research before investing in a stock. Now, unless you're investing in an index fund with a lot of stocks, I don't expect you to do your analysis on all the stocks. You can still do an analysis on a few of the top positions in that index fund. But if you're doing one stock, you need to watch videos, read articles, news, go to something called Investor Relation. Investor Relation basically is their website telling their investors or people who want to invest in the company about them. It gives you their quarter reports, like first quarter, second quarter, third quarter, fourth quarter, all the reports you need to know. It also tells you if they're like expanding or something like that. It'll let you know on like anything like that. So I really think that it's really important to do a lot of research, and if you're not going to read articles, at least like watch videos and then go to Investor Relations. That's like one of the top things you can do, the Investor Relations. Now with that being said, I think I'm going to end the video. If you liked it, please subscribe, like the video, and comment, and bye guys.